Hello and welcome to the Gold, Goats, and Guns market report for today, April 30th, 2023. My name is Tom Luongo and we have a lot to talk about. Quick shout out to all the new patrons. And it's a beautiful April morning here in North Florida. I don't know what else to really say. If this is your first time in Fight Club, please stay all the way to the end. I've been getting a lot of questions and comments recently about getting a formal education in my version of technical analysis. Now, and they come in through the Patreon DMs all the time and through questions on Slack and the rest of it. The problem with this is that it's really not very detailed. It's actually, and I'm going to go over it in detail again this morning. It's going to take 3 or 4 minutes. And it's really all it should take because there's like 4 things to learn. And then that's it. And then everything else is just interpretation after that. And once you get those 2 or 3 rules down, everything else doesn't really matter. Now, everything else just kind of should just fall in. It doesn't really matter. It should just kind of fall into place. So unfortunately, I'm going to have to do that for the veterans. You're just going to have to grin and bear it. And it's just something I can formalize this, but because there's no real good way of keeping, because there's no repository for this stuff, because there's no good places on the way the blog is, Patreon is a bad interface for what we do. And that's one of the things that Dexter and I have spent a lot of time talking about, how we're going to improve that for the future now that we're at a point now where it's over 3,000 people. So for those of you who are, very interested in the technical analysis side of things, which is important to understanding how this all works, bear with a couple of basic rules, listen to them very carefully, and we'll go from there. Okay? All right. OPEC. So the IEA came out earlier this week, the International Energy Association, which is, another one of these godforsaken globalist institutions that are so goddamned important. I'm in a foul mood this morning, by the way. So if this is more NSF, more not safe for, for work than it normally is, well, I'm sorry. I'm not in the best of moods this morning. But the IEA came out and said, hey, OPEC, you don't have the right to manipulate oil prices. And be careful manipulating oil prices. To which OPEC shot back and went, yeah, back at you. Which is exactly what I've been screaming about for 6 months, right? That they've been manipulating the oil futures market for months now in order to, and, through sanctions and the futures markets and everything else. And they had the unmitigated gall because, these people are unbelievably shameless, narcissistic sons of cocksucking bitches. To say, oh my God, OPEC, you don't have the right to manipulate oil prices by changing your production quotas and all the rest of it. I'm like, okay, boomer. Like, seriously, I'm at that point with these people. But it was great to watch OPEC come back and go, yeah, right. You stop manipulating the dollar futures markets and stop putting sanctions on everybody that looks at you sideways. And, we'll consider, allowing for a more open market for oil. Which leads me to this morning's the crux of this morning's commentary. There was a positively ghoulish article on Zero Hedge this morning, which I called them out for. It didn't feel like it was written by them. It felt like it was written by, some friggin' neocon think tank or Bloomberg or whatever. But it was this big article about India, and the title is that, India is basically, the EU is buying Russian oil still, and they're just, they're just buying it from a markup, at a big markup from India, which is something we've all known for months, or over a year now. But it was the second half of the article that was the most important, because it was a whole series of points describing the situation and then getting to the conclusions, and the conclusions that the author supposedly, because no other byline than Tyler Durden, that give up sanctions, you needed to start going into full trade embargo. And it was written as, not as an, oh my God, what are you doing going to trade embargo? This is supposed to be Zero Hedge, the bastion of free market economics in finance. No, it was just, you need to do this. I mean, the Tyler that wrote this article, and I'm like, this can't be a zero hedge guy writing this. This has to be one of these articles that they scraped and forgot to put the byline up top. And it felt like a Simon Watkins article, to be honest with you, over at oil price. So I went over to oil price this morning to check to see if I could find the article. And the first thing I see on the front page of oil price, which is a site I don't like checking, and it'll give you two reasons why I don't like checking oil price. The first is because it's mostly neoconservative in its worldview. And again, guys like Simon Watkins and some of these other MI6 agents that write editorial comment at oilprice.com are, clear intelligence assets. And then that's the first reason why. The second thing is while I was there using Opera as my browser and not Brave. I use two different browsers, by the way, on a daily basis. I use Opera and Brave. And Brave is where I go for most things. But there are some sites that render better in Opera. Investing.com is one of them. So is like things like the CME and, for the futures prices and stuff like that. There's just certain things that, render better on Opera. So I have those two browsers in my open at all times. And mostly I have all the financial stuff in Opera, and I have all the general browsing stuff in Brave with shields up as much as I can get away with. So I don't normally notice this stuff, but I also have Bitdefender running on my machine. And I'm at oil price for no less than 30 seconds, and Bitdefender comes popping up. Oh, by the way, we blocked a connection from oilprice.com through Opera to, these various Chinese websites. I'm like, oh, Christ. So, oil price is completely infiltrated by the Chinese and MI6 and writing copy from MI6 and CIA and everything else. And I'm sure that's all part of the intelligence stuff. So I don't even like going to oil price in the first place. So this is all a big preamble for point number 2, which is that there's the headline, top of oil price this morning. The biggest change to Brent crude ever is about to take place. Now, y'all know, longtime subscribers know that I only ever quote Brent crude. I don't quote WTI. I don't track the price of WTI, except as maybe the Brent WTI spread, because WTI is not used to index the price of most of the oil in the world. Most of the oil in the world is indexed to North Sea Brent, period. It has been for a long time. It used to be about 85% of all oil quoted was quoted in relation to Brent. Hell, even the Russians, used to, would set their tax policy based on the price of Urals, which is almost always quoted in Brent as a premium or a discount to Brent, usually as a discount to Brent because of the cost of doing business and converting into rubles and blah, 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 blah. So the Russians always have had to, take $5 to $7 a barrel less for their Urals grade under Brent crude. Now it's $25 a barrel, but, whatever. But there's a big change coming to the Brent crude index, and that WTI will become a part of the Brent pricing index from here forward. Now, WTI has traded at a discount to Brent anywhere from $4 to $8 over the last 5 years, because WTI has been in huge supply, and Brent hasn't been. The output on Brent has been falling, and WTI has been rising, right? So what is that going to do? Well, the big thing, of course, is that it's going to support the desire to bring the price of Brent crude down to try and limit the amount of money that the Russians make on their oil price. They're trying to push the price down, because if WTI trades at a discount to Brent, once WTI is added into the index, Brent is going to drop another $3 to $4. Because the gap right now is about almost $4. So figure even if they add WTI in as half or 35%, it's still going to narrow that spread again, shave a couple of dollars off the price of Brent, keep the price of oil under control. The goal here is to continue to control the price of Brent crude and keep it as low as possible. All right, because part of the neocon goal has been to starve Russia by limiting the price that they can get for their Urals grade, which then flows directly to the bottom line of the government's tax receipts, because their tariff rates are based on the realized price of Urals grade. So, in effect, the Russian budget surplus slash deficit is directly tied to the price of Brent crude, which is why Janet Yellen worked so damn hard to get the stupid oil price cap in place on Russian Urals grade, seaborne Russian Urals grade, which they have now cut off almost completely from European trade, right? So now all that oil goes to India, gets refined and or blended, and then sent back to the Europeans who pay a higher price for it. I guess this is a geopolitical twofer because it makes oil, an energy that's quote unquote not renewable in Europe that much more expensive, bankrupting the middle class in Europe that much faster. It also provides a new market for the massive amount of oil coming out of West Texas, Permian and whatnot, Niobrara and all that, the Bakken. And, because U.S. oil production is back up over 12 million barrels a day. And that's that. So, Kamina agrees with me, by the way. So, there it is. So this is a big deal. This is, again, another one of those things where they're just desperately trying to keep the price of oil under control by changing the definitions. So the Russians have already countered with this, and they've already got changes to the budget laws under consideration that they'll move away from tying to Urals and or Brent, and they'll move to something else. I think they'll move to Dubai or some blended price between Urals and ESPO and all that. They can do whatever they want. They're the Russians. They can change the law. It's not a big deal. So it's all quite sad when you really stop to make when you stop to listen, you start to think about all of this stuff. So in the way that this is playing out. But they never underestimate their willingness to go all the way to the mat for whatever it is that their policy is, right? They'll never stop trying to make moves. Well, if you do this, then we'll do that, and then we'll do this, and then we'll make this more complicated, and we'll make that more complicated. And then you can see how the world just becomes this morass of just bad policy. And it just continues. They never admit defeat. They just always look to figure out another way to play another angle to get what they want. Meanwhile, the rest of the world goes, you know what? The hell with all of this. We'll just use a different index. And okay, you think you have power, but all you're doing is making things worse. And then if you think about these things, all of these things from the Davos perspective, what's it doing? It's driving even more oil to be priced in other currencies, which then puts downward pressure on the dollar. What's that doing? Right? This is the whole plan. It's to destabilize everybody. The United States looks like they're getting something on the one hand, but on the other hand, they're getting something else because people can't think through second order effects. So, I can sit here and literally do this rant until my voice gives out, and we still won't get anywhere because the truth of the matter is that it never ends. And every week we just go through the same stupid tit for tat, dumb policy descriptions of what's going on. The IEA says stop trying to use production cuts to work against our sanctions policy. The OPEC turns around and goes, stop using sanctions to undercut our bottom lines and our budget. I'm like, it's not. This is the fight of the century, and I know who's going to win. It's not hard. People need energy, and they're not going to, they can't power industrial economies with solar farms. Sorry, you just can't. You can't power it with wind farms either. I don't sit here anymore every time the wind is blowing like it is right now going, damn, I really wish I had a windmill outside. No, I don't. I did that for the first couple of years I was at this house. Now I just look at it and go, God, the only thing I can think of now is that the friggin' the windmill turns so friggin' hard that it blows up my friggin' inverter and starts my house on fire. So, there you go. All right. So, again, electricity generation is difficult. It's not easy. Steady state is better than variable state. It just is. In every way. Predictability, simplicity. Like, these are the things that make modern economies run. And, you know, that's clearly not what we're allowed to have. Because, because. All right. So looking at the charts this week and what they all mean, it was very clear. Wednesday morning, I think I did the market report and I was talking about how the German-U.S. spreads were collapsing. Like they were moving really, really quickly to the downside from Germany's perspective, meaning the 10-year U.S.-German 10-year was under 1% and all that. And then literally within 3 hours, Christine Lagarde moved it like 7 basis points. And then it continued for the rest of the week. And then she got some support from Ueda over at the Bank of Japan, who said, we're not going to change our yield curve control policy for the foreseeable future. Now, this is contrary to what I expected Ueda to do, but, it is what it is. I don't know that, again, you're not going to be right about everything. You read the tea leaves and you think stuff through and you say, okay, well, what's going on? But again, the Japanese 10-year is still trading below 0.5%, which is the limit for their yield curve control program. There's a number of ways that can be interpreted. And again, there were 2 attempts on Prime Minister Kishida's life in the last week. And then the Bank of Japan comes out and says, we're going to hold on to yield curve control. Things are dangerous out there. They're really dangerous. So I don't know if Ueda is a good guy or a bad guy. I don't know. I don't know really that much about him. But so far, early reviews aren't good. Looks like Davos. Smells like Davos. Probably is Davos. But that may change in a few months. Because he's also serious about, having to, clamp down on emergent inflation. But inflation in Japan is now running over 3%. We'll see what happens when inflation gets up above 4 or 4.5. And Mrs. Watanabe is losing 4% a year. I mean, the best thing that can happen to Mrs. Watanabe is for the Bank of Japan to give up yield curve control at this point. Because then Mrs. Watanabe would rotate out of Japanese government bonds and into Japanese stocks, Japanese equities, which is kind of what I'm waiting for. Because I really want to go along Japanese equities. I kind of want to go along the Nikkei, right? But I can't until Ueda gets out of the way. Now, why wouldn't Ueda get out of the way? Well, these are the questions of the age now, aren't they? All right, so let's get into the charts. I'll get you out of here. All right. So we have both weekly and monthly closes today because today is the last day of April, and I've got an article due for Newsmax after I get done with this morning. So I'm going to get out of here as quickly as I can, but I've got a lot to go over this right now. So let's start talking about some basics of technical analysis. Okay, there are 3 types of bars. For all you old folks that have been here forever, you can tune out for the next 3 or 4 minutes. Okay, there are 3 types of bars. There are inside bars, outside bars, and engulfing bars. Inside bars are really simple. It's like this bar right here. It's a bar that when you compare it to the previous bar, broke neither the previous high nor the previous low. Nice and simple. The range of the current bar that you're looking at is inside the range of the previous bar. Right? That's it. That's all it means. Now, why is it important? Well, because less than 15% of bars are inside bars. That's why. So that's a big edge. Anything that is not a coin flip is what you're looking for. You're looking for things that give you tradable edges in all of this. Quantifiable tradable edges, right? Where you can quantify your pot odds and then make a bet. And if the thing happens, then you can, if you've got a high probability setup and you put some money on the table, you've got a high probability of getting paid. This is no different than calculating pot odds if we play poker. So 90% of what I talk about here can be learned by calculating pot odds in poker. And that's and that's 5 minutes worth of work in an article on a website. Okay? So inside bars. Break neither the previous high nor the previous low. Outside bars. Well, that's where you break either the previous high or the previous low. You broke one of the two. There's 3 states, 0, 1, and 2, right? Now, that's where your tradable edge is. Well, yeah, that's really where your tradable edge is. Because 85% of bars, on average, depending on, every thing is different. Every currency, stock, metal, whatever you're trading is slightly different. And you can calculate the numbers for those, right? By just going back and grabbing a whole bunch of open, high, low, and close data and doing some histogram work. It's not hard. It's very simple Excel stuff. Did you break the previous high? Yes. Did you break the previous low? You checked versus either of those. You subtract one versus the other, and if you get it's not hard. Okay, basic math. Like, there's no calculus involved in any of this. Hell, there's not even any algebra. Okay, it's just counting and sorting. Okay. So inside bars, outside bars. 85% of bars either break the previous high or the previous low. This is an outside bar. We broke the previous high, but we didn't break the previous low. And then an engulfing bar is exactly what you would expect it to be. It's where you break both of them, like this bar right here. Break the high, break the low. You've engulfed the range of the previous bar. Now, why is that important? Well, it's important because highs and lows represent emotional extremes in the markets, right? So a high is where the supply of sellers overwhelms the supply of buyers and are able to push the price away from the high, from whatever the high price was. At the high, the market was kind of in balance between buyers and sellers, right? It's kind of at equilibrium at the high, right? There's an equal number of buyers, an equal number of sellers. And then once the price moves back away from that high, now the sellers are overwhelming the buyers. The buyers are less committed. They don't want to take the price any higher. The sellers want to take the price lower. The sellers went out, the price moves down. Well, the same thing happens at a low. Right? The sellers keep pushing the price down. Eventually, there's enough buyers come in to support the price. And you get a low forms, and the supply of buyers overwhelms the supply of sellers, and they move the price back up. Right? So that's why highs and lows are important. They represent emotional extremes in the markets. Okay? Emotional extremes in the markets. None of this has anything to do with market fundamentals, other than the traders' perspectives on and perceptions of what they believe the fundamentals are. But that's all second, third, and fourth derivative in mathematical terms of what they're actually doing, of what their behavior actually is. Because, there's a lot of different types of players in the market. There are momentum players, there are swing traders, there's day traders, there's long-term investors, there's Mrs. Watanabe, there are informed investors, there are ignorant investors, there's everybody in the market. There are retail muppets and then institutional buyers and sellers. Like this, everybody's there. The market just aggregates all their behavior. And the market, and this is why the markets, quote unquote, don't give a shit about fundamentals. And if there's the one thing I can teach you outside of Malthus is always wrong, that Malthusian thinking is always wrong, it's that the market doesn't give a shit about what you think the fundamentals of a stock are. Okay? Markets trade on momentum and sentiment. They don't trade on fundamentals. Fundamentals inform momentum and sentiment, but they do not determine momentum and sentiment. This is why so many kind of classic fundamental traders fail, and fundamental fund managers and market analysts fail, because they refuse to accept the idea that fundamentals don't matter. Markets can stay irrational longer than you can stay solvent. Why? Because markets can stay irrational longer than you can stay solvent. Why? Because psychopaths can stay in the market against your position longer than you can stay solvent and take all your money from you. And if you've ever been bluffed off of a big pot you should have won at a poker table, you know exactly what that feels like. And if you've not played that game, and if you've not done that in your life, and you don't know what that feels like, you shouldn't trade. Even those of us who have been in that situation. Many of us shouldn't trade. But you can still analyze the stock to try and figure out where it is, and is it at a good buy point or a good sell point. So, now that we understand all of those basics, those are the basics. That's 75% of it. Now that you understand why highs and lows are important, and then why closes are important, because closes aggregate an entire time period and say this is what the market thought of that stock or that metal or that currency at that moment in time. And for all markets except for Bitcoin and cryptocurrencies in general, closes are very important because markets close. They don't trade on the weekends. And so people have to live with their positions for up to 72 hours. So a weekly close or a monthly close in the Dow or gold or Microsoft or whatever is important, because for 3 days, 2.5 days, someone has to sit on that position and go, yeah, I'm comfortable with that, and not being able to trade it. And that's why closing prices are so important. That's why you wait for a close at not just a violation of a previous high or a previous low. And that's why this is important. So now we get into the concept of what can we do with this? Well, what we can do with this is then we can start identifying reversal signals. Right? All we care about now, I'm very similar to Alex Craner, and I just like to follow trends. The question is, which trend? Is it a weekly trend, a monthly trend, a minute, a 10-minute trend, an annual trend? Time aggregates, time period, time frame should be matched to the type of investor you are. If you're, a hyperactive, adrenaline-addicted Momo monkey, you're trading 10-minute charts. And if you're a long-term investor like, Warren Buffett, you're looking at monthly, quarterly, and annual charts where you're aggregating large time frames to get a sense of what all of the market players are doing. Because the 15-minute charts don't aggregate the Warren Buffetts of the world. They're not. Those price movements are not reflecting their behavior. The monthly charts are reflecting their behavior, or the quarterly charts are reflecting their behavior. Or at the very least, they're reflecting a higher percentage of their behavior. Okay? So let's define a reversal signal. A reversal signal is when you close against the previous trend. So here's a perfect example of what I'm talking about. Here's a 4-bar downtrend, right? Bars, we open high and we close low 4 weeks in a row, and price moves down. Now we get this bar, which is an engulfing bar because we broke the previous low and the previous high, and we closed above the high, the emotional extreme of the previous down bar, which is bearish, and we closed bullishly above it. That's a reversal signal. Not only is it a reversal signal, it's a 1-bar reversal because it happened within the next bar. And 1-bar reversals tend to hold their water and truly reverse and continue the new trend 85% of the time. Like this one. And it's an engulfing bar, so we saw a previous low. We broke a previous low and the previous high and closed above the previous high. That's huge. That's as bullish a signal as you can get in this system. Period. There's no other signal that's more powerful than the bullish or bearish 1-bar engulfing reversal. Right? Look what happened here. We closed on the low, practically on the low. Had a massive 95, 98% chance of breaking the previous low versus the previous high. Right? Because all you had to do is traverse that little bit of difference down there. And then it shot right against it and closed against it the next week. It's a massive move, which is what sent gold from 1,800 to nearly 2,100. And we got a big move up, trade sideways for a little while, break a little bit higher, establish a new high, neatly by about $1, avoid a reversal here, because the close here is hard to see, but the close here was about $1 above this low. So no reversal there, even though we violated. Why closes are important. We violated the low, but it's not a reversal. It's not a reversal because you didn't close below the low. And then the next week you follow it up with an inside bar. Meaning the sellers are spooked. They don't want to take it back to the previous low, but the buyers aren't confident yet. So they didn't take it above the previous high. So now the market is sitting here going, oh, what do I do? Coming into the monthly close in gold. So all this fight, all of this interesting stuff that's happening here aggregates down to, oh, well, what does it look like here? Well, we have the same thing. We have a 7-bar downtrend here. We have a 1-bar, not maybe engulfing, I'm not really sure, reversal on the monthly chart 6 months ago, right? Here's the reversal signal right here. A nice 3-month uptrend. An avoided reversal here, and then a continuation. Because this reversal was avoided, and then we closed above this high, we got even more upside. But then we closed with, far away from the monthly high, but it's still, in gold terms, an all-time monthly high closing price. Like, we've never closed a month higher than this price than we just did in April. So not only do we have, at the short-term level, the weekly level, an avoided reversal bar with an inside bar set up for more upside this week, but the highest all-time monthly close. The problem, we also have a double top here on the monthly chart. What this means is, as I keep saying, the fight for 2000 continues. This is a big deal. And you would expect the market you would expect a lot of uncommitted bulls to lose their, to lose their shit above 2000. You'd see a whole lot of, overconfident bears come in at 2000. And then there's a whole lot of malign actors who don't want the price of gold to rise above $2,000 because it makes them look bad, coming in to help, to keep sitting on the price. But constructively, note the series of lows here. The series of lows keeps rising, even within this kind of consolidation, right? This fight, big fights going on, but the buyers keep coming in at higher prices. That's also bullish. Again, these bars tell you a story. As long as you know how to read them, as long as you understand the market psychology that goes into them. Okay? So, and sometimes if it gets noisy like this, you're not really sure what this means, back out and look at a longer time period. And, like, you can get weekly and monthly data from anywhere. Almost anywhere. Don't go to stock charts. They want you to spend money to get monthly charts when you get them for free from investing.com. Quarterly charts, annual charts, those you'll usually have to build yourself. I do them in Excel, but there are other services out there that you can pay money for. I refuse to pay money because I'm cheap. And I also have a system. And I've been told, I've had a lot of people come up to me and, say, oh, by the way, you can, spend this a little bit of money and then you can get these really advanced charts with this service. And I'm like, yeah, but I like hand building the charts. Even Dexter gets angry with me about this stuff. And the reason I like hand building the charts is because then I have to spend a little bit of time looking at these things. It's a bit of a meditative thing. I get a time to live with these charts for a couple of minutes, and then I can move on to the next thing. Sometimes the story is very obvious. Sometimes it's very subtle. Silver. Now that you know all the rules, those are all the rules. And if you see a reversal signal, like here's another one, one last rule. When you see a reversal signal in a shorter time frame, immediately go out to the longer time frame and see if it's significant. Because look, we had a reversal here on the weekly chart. Ooh. And then it translated into a reversal signal on the monthly chart at the same time. Homework. Did it translate into a reversal signal on the quarterly chart? You can do the math. You can plot this out. All you got to do is grab the highs, grab the lows, grab the open and grab the close for every 3-month aggregated period from January to March, April to June, July to September, October to December. Keep doing. That's what I do. I hand build them. I aggregate the data all the time. I didn't look at the quarterly chart because we're in the first month of the quarter, so I don't even care at this point. But by the way, April's high was greater than March's high, and greater than February's high, and greater than January's high. So guess what? We've already broken the previous high in Q2 in gold. What does that mean? It means that there's a very low percentage chance, because only about 3 to 5% of bars are engulfing bars. It means that there's a very, very low probability that we're going to see gold drop back to these lows. Because it doesn't normally happen. It would be a 7 sigma event at this point. 6 sigma, 6, 7, 8 sigma event. Okay? This is the power of understanding these things. Okay? So this month, we have a 37% chance of breaking April's high in May. We have a 47% chance of breaking April's low in May, based on Friday's closing price, and that if gold opens at Friday's price. Probably won't. Probably these numbers will adjust a little bit depending on what happens. Okay? But for the most part, that's what these numbers are. I just plug Friday's close into next week's open and then do a simple analysis on them. Okay? Just to see what the rough idea of where we're going, so that there's nothing discontinuous. If Friday's close propagates into Monday's open or Sunday night's open in gold's case, then we have a rough idea of what our pot odds are of going higher or lower. And here on the weekly chart, it's a coin flip. On the monthly chart, it's also a coin flip. Okay. Also note that when you sum these two numbers together and you get 100, that's previous week's normal volatility or previous month's normal volatility. Going back in this case, 254 weeks for gold and 84 months for gold. So 5 years here, 7 years here. Over 7 years, the average monthly range is $75. The difference between the closing prices is $40. You can only expect. This is why this is important. Difference between closes. What does that tell you? On an absolute value basis, you're either going to gain or lose $40 in gold every month. So if you get more than a $40 move in gold during like 2 days into the month or 5 days into the month, you think you're not going to get a correction on the weekly chart at some point. That's what these numbers are for. When the sum is greater than 100, you have less than normal volatility because you're closer to the low. The closing price is really close to the low and it's really close to the high. So that means that the range of the bar itself was really low, meaning in this case, the range of the bar was less than $41. When it's higher than that, when it's less than 100%, that means that the high and low are farther away, lowering the probability that you'll break them, and therefore the range here was greater than $75. Okay. All right, that's it. All right, the oldsters, you can come back into the market report. All right, or OGs, you can come back into the market report. Silver. Silver broke the previous low last week, but closed up in here. This is great. After a huge move like this, to see no commitment from silver traders to take the price on a closing basis back below $25, which is way above this cluster of highs here. If you draw a horizontal line across the chart, you'll see some what used to be resistance, which we broke through, and now it becomes, and former resistance becomes support once you're above it, right? So that's why this is important, okay? That's why breaking highs and lows are also important, because now projecting out into the future, if you were to take this line, propagate it, here and go all the way back, you'd see what I'm talking about. But you can draw one like right here. These lows, you can draw these, a line between here, here, and here, and draw a straight line across. And then you can say, well, it will probably correct back to that. Well, in silver's case, we should see a retest of the low 24s, which we did, and we bounced right off of it. Very bullish. This is kind of bullish consolidation of previous gains, right? The bulls are not done trying to push silver higher, but they are backing off on their positions a little bit because, trading is dangerous. You could lose your money. So backing out into the monthly chart, what do we have? Well, we have a close this month above these highs. That's very bullish, right? We had a 2-bar reversal here, correct? Right. So here's your 4-bar uptrend. Here's your 2-bar reversal. It took 2 bars to close below this low on the monthly chart, which was then not reversed, but we got a new bottom formed. And then we had a high probability setup that we would break the previous high and then get some momentum and possibly even break these highs here, which would then constitute a reversal. So this is an uptrend that's reversed with a 2-bar reversal. That's then immediately reversed with a 2-bar reversal. This is one of those 2-bar reversals that failed to continue the trend. This is that 35% of the time when the 2-bar reversal fails. Then again, this was also greater than normal volatility, and therefore was all the energy expended pushing the price down to here. And then the bulls just came in and said, you know what, $20 on silver is a steal. And now we're back to 25. And now drawing a horizontal line off of this high closing price here, you can see we closed just shy of it in April. We got a pretty, and then we have pretty ugly probabilities for this month. But again, silver right now looks like its volatility is starting to rise, which is usually a good sign for, if we've got an uptrend, that the uptrend is going to continue. We'll see, but that's where we are. Silver looks good, both at the weekly chart level. Hey, we're getting a little bit of a pullback, consolidation, people forming up their positions, getting used to the price of 25, and that propagated into the monthly chart of a 2-bar reversal. I got news for you. Technical traders are going to look at that 2-bar reversal, and they're going to buy it on the open. And we'll be shocked if we don't see a buy on the open. We also have 6 to 4 pot odds that we're going higher versus lower this week. Right at normal volatility. This is normal volatility for silver. Some here is 102%. Can't get much closer to 100 than that. And we got 6 to 4 pot odds. 60% chance of going higher, 40% chance of going lower. Right? Not a great probability setup. So if you were a guy trying to trade this, I wouldn't trade this. Right? I would wait for the price to break the high, and then I would go long. And I would give this up. I would give this distance up. Because if you get the break here, you'll probably get a move to 26, and you've got more upside waiting for the break than taking the chance here that you'll lose 60 cents to the downside. But that's me. You do what you want. Bitcoin. Same thing with gold, really. Bitcoin avoided a reversal signal 2 weeks ago. You can't see it because it's like within a couple of dollars, but it did. And then we got a nice double bottom here. Well, triple bottom, really. This is all these clusters, all these lows here are great because there's no closing prices below really like 28,000. That's good. We got a nice move back into the 29s, and this is this morning. Now, Bitcoin hasn't closed for the month yet, though, because today is April 30th. So at 12 p.m. Greenwich Mean Time tonight, we will get the actual official monthly close for Bitcoin. But unless something catastrophic happens, all we have now is a nicely formed 4-month uptrend in Bitcoin. We had the massive collapse from 68 grand down to 16. The downtrend continued on the monthly basis, right? All this noise gets normed out to this nice, big, strong reversal signal, breaking the high here, and closing above the open. And only going back, it broke 4 highs on the close, closed high into the end of the month, and then took its time and then broke higher with a nice, correction and engulfing move higher. Right, all good. I think Bitcoin looks great here, and I'm really happy that we killed the reversal signal. Because remember, in order to reverse this uptrend, we had to get a close below this low to get the 2-bar reversal here. The reversal was avoided completely. And with this level of volatility, I wouldn't consider this a continuation of this uptrend. Right? This uptrend's been arrested. Now we're setting up a range trade between 27.5 or so and 31,000. And now what we're waiting for is a break of this high. Or this high. I think Bitcoin's going to trade in this range for a few more weeks before it decides what it's going to do. Or at least for the first couple of weeks in May, and then it may try and move back towards the 30s. Because look, go to the monthly chart and you've got support, you've got resistance here, 35, 36, right? 40. All right. Brent crude. So looking at Brent crude on a weekly basis, I kept telling you that when we got the big OPEC production cut over the weekend that pushed the price higher, and then I'll be honest with you, Davos sat on the price for 3 weeks in order to force it down, in order to fill the gap. We got the gap filled this week. We didn't get a close below the top of the gap though. This gap here. That's good. Oil's not in a good position. They're in control of the market. The bears are in control of the market, and you can see it here clearly. But that's a very unnatural pattern. There's not much appetite for oil below $80. Okay? So I look at this as kind of an ugly and violent consolidation, as OPEC and Davos fight it out as to who's going to win and what the price of oil is going to be. Geopolitically, we know that that Davos desperately wants $50 a barrel oil. The Biden administration wants to refill the SPR at $50. They also want to get gasoline prices down below $3 a gallon, and they need to break the market. I don't know if they're going to be able to do it, but we'll see. We've had a lot of requests for natural gas stocks in the last few weeks, and I've got one this morning as well. So I wanted to do natural gas. I hadn't actually looked at the long-term natural gas price from a technical perspective in a while. I've been noting the nat gas price here and there, and I knew kind of intuitively that we had a reversal signal 2 weeks ago, because I knew we were trading at 2, and then we're back above 230, 240. I'm like, we have to have thrown, just intuitively, I'm like, we had to have thrown a reversal signal. I was correct. We get a little bit of an engulfing bar here, but continuation of the uptrend. It's very strong. So the weekly chart in nat gas is showing bottoming action here. We got a bottom here. We have some bottoms here. So anything below $2 is getting bought, and the market is firming up. We're into the middle of the summer now. People are going to be turning on their air conditioners and refilling, for the fall, for the winter, and blah, 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 blah. So nat gas prices are going to start rising. Old wells that were not replaced will be drying up. They'll start drilling new wells, but, will they drill as many replacement wells? That's a good question. I don't know. I haven't been following that very closely. But the price of natural gas looks like this is clear bottoming that's been going on for the last 3 months. So that's good. But when you go out to the monthly chart, you can see an epic collapse from $10 all the way down below 2. But this is an inside bar that we threw in April. So inside bars aren't a tradable thing, but you can say that you look at them as potential signals to pay attention to, right? They're the kind of thing that, well, hey, we didn't break anything. Is the market setting up for a reversal? We know this isn't great. This isn't a great setup for May. That will get a 2-bar reversal here, opening here and closing above $3. But if we do get it, you can probably say that, yeah, we'll be moving back up into the $3-4 range. But I don't think that's going to happen in May. I think what we'll see is I don't know. I mean, my personal feel on this is that we're going to get a whole lot of bottoming action here between $2.50, $2.40, and $3 for a couple more months. Certainly into the end of Q2, and then into early Q3, we may get a breakout from consolidation. It'll show up as kind of a noisy pattern down here on the monthly chart. We'll go from there. Okay. Oh, I forgot to animate this, so ignore Blackstone Minerals for a minute. Let's just talk about MP Minerals. The April breakdown in MP Minerals to 2167 on the close was bad. We closed below long-term support at 2250, 24, right? These lows here, not good. I don't know what the volume numbers are, because investing.com's database is not particularly good. So you ignore this stuff down here. I usually cut the volume off unless it's interesting. So just ignore this. So this is a U.S. Rare earth metals / rare earth magnet producer and a play on the electric vehicle industry. It's a nice idea, but I went through their balance sheet. 2022 revenue on a quarterly basis, quarter over quarter, all the way through, down. They must have lost contracts. Rivian is in trouble, blah, 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 blah. They are richly valued with negative cash flow right now. So even though they're trading with a trailing PDE of about 13, there's a very good chance that the stock could drop back into the teens or even the low teens. I'm not convinced on EVs at this point. We'll see what happens. I think the auto producers are being struggle sessioned into having to build EVs that they do not want to build. Okay? That's what I think. And I think the minute there's any kind of political shift away from this CO2 madness, the car companies go right back to giving us, 5.7 liter V8s, which would make me very happy. So, all right, Blackstone Minerals. This is like Permian Basin Royalty Trust, which we have in the portfolio, an oil and gas royalty style company. I don't know that they're really an oil royalty trust. I couldn't quite grab that from the profile on investing.com. That's all I did. But if you're interested in this company, you'll know. It is an LP, so it is a limited partnership. So it's maybe not a royalty trust, but certainly some kind of limited partnership designed to distribute large amounts of its profit as cash flow to investors. It's got a very high yield of around 11%. There was a big top with natural gas 6-7 months ago. Well, actually, the top in natural gas happened here. There was a blow-off top in the company, in the stock price. We get a 4-bar downtrend. No reversal signal here, though. Nice bottom. I mean, it's hard to fault this as not a reversal signal because, seriously, this is a big collapse and then move back. So honestly, technically it's not a reversal signal, but this is a $4 move. This is a 25% rally. That's how much the stock off the low, how much the stock collapsed and then has retraced. So really what you want to say is there's no appetite for this stock to trade below $15. And at this point, technical reversal definitions aren't really all that important. I would actually almost say that this could have easily been a down bar, and then this is a 1-bar reversal this month, even though this is an up bar technically. But given the breadth of this bar and the breadth of the reversal in price this month, and the good news is that during the downtrend, volume was falling off, which is good, but there wasn't great, volume follow-through action to the upside. But then again, natural gas is trading at, 240-ish, a million BTUs, right? So accumulate the stock, I think, below 1750. If you're bullish on that U.S. natural gas, right, here. And if not, then put in stink bids at around $15. Again, forgot to animate the chart. So let's look at Tilray. I'm going to make this really short and sweet. It's a cannabis stock. Why are you in it? Look, Scott's Miracle-Gro Company couldn't make money in hydroponics and the picks and shovels end of the cannabis industry. If anybody was going to make money in cannabis, it was going to be Scott's. And they lost their ass. This stock is cheap, but so what? Unless you are high on this industry, which I'm not, then just stay away. This is a tax farm play now, meaning cannabis is now nothing more than an industry to be highly taxed for state governments that have legalized. That's it. All right. Guanajuato Silver Company, very interesting little silver company. I did a quick look at their balance sheet and their business model. It's right in line with what I like. So if the subscriber is a newsletter subscriber and knows my preference for silver miners, right, then this looks like a sister stock to the one we have in our portfolio. In this case, EXK. And it's got a very similar business model to rehabilitate old Mexican mines, right? And that's good. It's got a little bit of debt on balance sheet. It's not a lot, but then again, it's also got a very small balance sheet. So the nice thing is I was about to poo-poo the balance sheet when I saw the debt, but then I went and looked at the last 4 years worth of shareholder equity. And the way the company is moving forward, it has added a lot of shareholder equity over the last 4 years. So this is an equity play. By the way, this is in Canadian dollars. This is the quote off of the Toronto Exchange. The US ADR would trade at divide this by the Canadian dollar rate of what, $1.37. So it's probably trading at about 37 cents. No, they're 40 cents American, something like that. 42 cents American. So, yeah. So I like the rising shareholder equity, and it's a sharp rise from year over year from 2019 to 2022. That's a good thing. So this is a good accumulation candidate here. And then Somebody finally figured that out. Ooh, look at that. So somebody bought this. I'll bet you the Sprott boys did, but that's just my personal opinion. Because they're probably looking at this going, yeah, they're probably seeing the same thing I am. So maybe it's a good spec bet in the silver space. Okay. I wouldn't chase price in this though. You know what you're hoping for? You're hoping for continued languishing of the silver price for the next couple of weeks. Get everybody like uninterested in silver again, so the price drops back to 40 cents Canadian, and then pick it up then. Because then the opportunity for it to go to 70 cents on a move of silver back towards 30, oh, that's how you're making money. Okay, but you got to follow just follow the price of silver and follow its sensitivity to the price of silver, and you'll be okay. All right. Silver versus LIBOR. We are 3 days away from the FOMC's meeting on Wednesday. Fully expect 25 basis points. I think the entire market is happy with the idea of 25 basis points. We are also noting that the SOFR curve continues to say that the Fed may again raise rates in late June. But it's not fully convinced about 25 basis points yet, but come on. And what we have this week was, a move back towards a slightly higher terminal rate. And, and even with the whole, volatility in First Republic Bank, and I'm really glad that I kept saying to everybody, every time I was asked about First Republic Bank, I kept saying, you know what, too early, don't catch a falling knife, too early, don't catch a falling knife. I certainly hope everybody listened to me, because the first time I did it, the stock was trading at 10. I said, it could go down to 7, but don't buy it. And now it's trading at 4. Okay. This is being too early on a stock, on a company that is in serious trouble and is in the crosshairs of, or is certainly in the crossfire of a big political fight, is not a place you want to be as an investor. It really isn't. I wasn't telling any of you to buy Bitcoin in the 16,000s until we were 6 to 7 weeks into that bottoming action. Same reason. Wait for the political ugly to clear. Then start thinking about it. Then really start thinking about it. And then just wait for a breakout and then buy the breakout. And you'll do okay. And with Bitcoin, sometimes you have to be more nimble than wait for a weekly close. You got to be like, no, buy the horizontal breakout, whatever it is, and then and be in there and just buy it, because Bitcoin's very volatile. All right. So there's not much going on here. I want to note that on Wednesday, like I said in the opening remarks, that we had these curves were far lower than this. They were 6 to 7 basis points lower that Wednesday morning than Wednesday's close. These are all closing prices, of course. So, and then we can see the massive buying spree that went on of the U.S. 2-year, probably because of First Republic Bank, on Friday. I think the ECB was in there, and certainly what happened with the BOJ, there was a lot of people thinking, okay, the BOJ is going to can allow me to keep my short yen carry trades in place. These spreads are too tight. I can make some money on the spread. Dollar index, though, is firming up, trying to push towards 102. I will probably put the U.S. dollar index up soon. We'll probably do it in a market report. The euro closed the month at $1.10, but again, it was inside of it was at the low end of the bar. And I really do think that the euro rally is very, very, very long in the tooth. The yuan was up a little bit. The yen, of course, collapsed after Ueda's press conference, or his policy meeting. The pound fell off a little bit. The ruble really doesn't matter very much. I just like to throw it up here just to show you that, oh, by the way, that now the ruble dollar is now inversely correlated to oil. That the lower oil goes, the more the ruble strengthens. It's a little weird. It just kind of shows you, how much the ruble dollar index rate, exchange rate doesn't matter anymore. U.S. German 10-year comes in at around 1.12, 1.3%, 1.13%, and copper's 390 a pound. Last thing to talk about is the Dow. All right, and let's not get too aggressive with the mouse wheel, Thomas. So here's our consolidation pattern in the Dow. Note the big engulfing bar here. Note the attempted collapse below the midline of this. I don't have it drawn in here. The midline of the consolidation price. So you just draw, a bisecting line across here, right? Which I've shown in previous market reports. And there's the remnant of it. I just move it up and augment things. You'll note that we closed above it because it was like the bisector is like right around here. Okay, so note that there was a huge attempt to, roll over and maybe reverse this uptrend, right? Because here's your 5-bar uptrend, here's your inside bar, and then, oh, look, we got a big move down, but then look at where we closed. This is why if you are on Tuesday or Wednesday screaming, oh my God, the Dow is going to collapse and it's a reversal and it's over, you look like an idiot on Friday. That's why you wait for closing prices, folks. And you match your time frame. This is a classic example of how a market can look really bad intra-week and really good by the end of the week, or vice versa. All of this shaded area norms out to this on the monthly chart. And again, look, attempted collapse outside of the zone, didn't work. Big, huge move higher. Not quite a reversal of this bar, but then again, this really isn't a downtrend. I mean, it is, but it's all within the context of the range of this bar. Basically, we're just trading within the range of this bar, and we're consolidating now after this 1-bar reversal of this big downtrend and the 2-bar uptrend, and then we're trading sideways and establishing a new range, just chopping within, a 1,500 point range. That's all we're doing. But we're chopping with an upside bias. So what happens with the Dow? Well, if you are accumulating below 33,000 or in the 33,000 area, and you're selling the 35,000 area, if you're trying to accumulate and swing trade this, or you ignore all of that, buy the bottom here, and then be happy when we get a violation to the upside here. And if you don't like this pattern, and I'm not saying you should or you shouldn't, but if you're bearish on stocks, then don't buy at all and just wait for a break of the area. But here's the thing. Note what happened the last time if you went short the Dow here. Everybody who was talking about the Dow was going to fall to 27,000 or 25,000 because it broke down like it did back in March, just lost their ass. Okay? And I was screaming that week that this was bad. But this is where fundamentals come back in. Right? This is where you say, okay, fundamentally, what would drive the Dow lower? What would drive the Dow higher? And what's more important? International capital flows, when the Dow was cheap, relatively speaking, or domestic economic stagnation. I'm always going to argue that international capital flow is more important. So that's my bias. It could be wrong. But in this case, it turned out to be correct. Right? And this was a significant close, I think, for the month. I mean, we closed above the midpoint of this range. Like, this is not a bad pattern. I mean, it's not. So, all right. I hope this was helpful and instructive for the new people who are really, who are interested in, raising their A game here, and trying to get the most out of this. This will be one of those that in the future, as we go forward, I'll just kind of go back and remind everybody, go watch the April 30th market report, because I think that's the best way of going about it. And I'll try and note that in my head from here forward. Watch the April 30th, 2023 market report. I'll do another one of these lessons in 3 or 4 months, but I will not do another organized one like this for a while. Okay? Because I just can't. I can't do that every time. I can do it every once in a while, every 3 months or so, when there's a significant number of new people who have moved in. But Unless we have an influx of 500 people next month, that's what's not going to happen. But I had gotten like 6 or 7 comments on this, and then the video I did with Crypto Rich, not this week with Alex Mercurius and Alex Craner, but the one I did with him on my own last week, the week before, well, the Saturday before, which is linked in Patreon. There's a full discussion of a lot of these concepts in there as well, where I go over it in detail for people. All right, so that's what I have. I hope you enjoyed it. I'm going to enjoy the rest of my afternoon by, writing an article for Newsmax. You guys be well. You take care. We'll talk soon. We'll talk Wednesday. Keep your stick on the ice.